It's Crystal from Pumped On Property and I'm with my brother Simon. Today we're going to be answering some questions that you guys have sent through on our social media channels. Let's just jump straight in. So Simon, first question, we've got someone here asking, what are the best markets in Australia that are below $500,000 currently?
Oh, the opportunities are becoming few and far between below 500K at the moment. I think we recently recorded a market update. Right now with the higher interest rates, it's dropped people's servicing and borrowing capacity by like 30%. So I think a lot of people are coming in with a lower budget. So it's a good question at the moment. You know, for me, I do specialize in the Queensland market. I know this area of Australia better than anywhere else. Second to that, probably New South Wales, where we grew up as well. So basically in New South Wales, there's not really anywhere where we see value below $500,000 anymore. It's just that market's seen probably more capital growth over the last decade than anywhere else in Australia. So it can be pretty challenging. And I do believe that Victoria is quite similar. I know there's some smaller regional markets in Victoria where you can find properties below $500,000, but these are in some really, really small regional towns. So I'd try to avoid those if possible. In Queensland though, there's definitely some good opportunities. For us, it's all about the fundamentals, right? So wherever has the strongest population, or the largest population and the strongest population growth, you're also looking for a diverse economy, so different employment opportunities, not just focused on one particular thing. And you also want to have relative affordability and good rental yields if you are going to buy in a regional market. And obviously the desire for that longer term capital growth. So, you know, the areas in Queensland where we really like at the moment is Townsville for a below $500,000 property purchase. I don't even think you can buy into Toowoomba anymore with below $500,000. And you definitely can't get into Brisbane for a good property below that price anymore. So Townsville would probably be my top pick. There's like over 200,000 people that live up there. You do have a relatively diverse economy. It's the third largest regional town in Queensland. It's the 14th largest market in Australia. You have the mining sector, the military sector. You've got good education up there with James Cook University. You've got good tourism. So it is relatively diverse up there. So that'd probably be my top pick in Queensland. Outside of that, I do see a lot of value over in WA at the moment. It's pretty tricky to find anything below 500K in Perth these days, unless you're getting quite far from the CBD. I know there's probably some areas maybe 50 kilometers from the Perth CBD where you could maybe buy for that price. So that could be a good option as well. But I do want to, you know, make sure that you guys realize that you want to have those fundamentals. You want to have, you know, at least more than 150,000 people living there. You want to have good population growth, 1,000 to 2,000 people per year at least. You want to have a diverse economy as well. So like, don't go out there and buy in a mining town where there's only 5,000 people that live there. That was a very long answer to say Townsville.
Despite like what you might see online and stuff like that, like if you're looking in Brisbane, there's going to be properties that pop up in parts of the outskirts of Brisbane with a listing price below 500K.
Yeah.
But you've also got to be really careful around what you're buying for 500K as well. Like in Townsville, that's going to get you a good quality property. Anywhere else, if it's listed below that, looking at housing commission, looking at flooding, looking at the insurance risk factors, because typically cheap in markets where the median house price is exceeding that price point is usually not so good of a thing.
Yeah, like in one of the more affordable suburbs in Brisbane, we saw a property sell for $497,000 and it was a knockdown.
Yeah.
And that was in Crestmead, which, you know, that's a cheaper area in Brisbane at the moment.
Exactly right. Question 2. This has come from someone, I live in Brisbane and can't afford a house. Should I be buying an apartment closer to the city or a townhouse a bit further out?
Oh, I can't predict the future, so I really don't know what's going to be better longer term. When it comes to your own home, I think it's personal preference more than anything because like it's where you're going to be spending most of your time. For me, like I love the beach and I go surfing 6 days a week. So I want to be as close to the beach as I possibly can. And like, yes, that does work from an investment perspective, but it means I have to pay a lot more money. So it's like, think about the lifestyle factors and the sacrifices that you're willing to make. If we're talking fundamentals, you know, we know that the power is in the land and we also know that townhouses generally allow you to hold a bigger piece of land. So I would personally go for a townhouse a little bit further from the city if I were in that situation. But if you like the lifestyle of the city being walking distance to really bougie, trendy cafes and restaurants and all of the other lifestyle factors that you get in a city, then you know, definitely not opposed to it. I would probably recommend avoiding like a massive high-rise apartment building though, because once again, your land component goes down, your strata and body corporate fees will go up quite significantly. So try to buy in a smaller complex, maximum 12 in an ideal world. So some of those old red brick walk-ups, I really like them in like Paddington and things like that, of Brisbane, and some of those other ones, Kembla Grange. There's some great little old school walk-ups that you can get into. You can buy one of those unrenovated ones, 2-bed, 1-bath, renovated into something quite beautiful. So I guess personal preference at the end of the day, if I'm thinking strategically, I'd go for a townhouse, but if I want to live closer to the city, I'd go for something that's lower density.
Yeah, totally. I think that's what a lot of people forget when they're buying a unit, is the holding cost. So if you're buying a high rise, it's got pools and gyms and lifts and all of these things, the strata is going to be really, really high. So just take that into consideration. You'd be surprised that buying something that needs a bit of renovation will possibly end up costing you less, even if you've got to do that reno, still being in a pretty good situation, distance to the city, without being in an ongoing, a really high cost apartment block. Love it. What does I assume Phil Anderson, expect between now and the top of the cycle?
Phil expects it to be a massive land boom globally over the next 3 years to the top of the cycle from where we're at right now. The biggest land boom that we've seen in history is his expectation. He believes that the writing is on the wall and this is going to happen. He's starting to see it around the world, like stock market's about to hit all-time new highs. Banking profits are massive at the moment. Insurance company profits are massive at the moment. Tech industry is just booming right now. A lot of property markets in the Western world, like the United States, Australia, New Zealand, UK, parts of Europe, are all moving forward at the moment. So he does believe that we're going to see the largest real estate boom in history between now, 2023, and the top of the cycle, which is expected to be around 2026, led by the United States. And then Australia, UK, etc. will follow suit from there. So he's expecting some pretty massive gains over the next few years.
Number 4, how will the downturn affect property prices in Australia?
I'm assuming they're referring to the 18-year cycle again.
Yeah.
Yeah, well, it's a tricky one. Once again, like, nobody has a crystal ball, and Phil bases his predictions off history, but history has a funny way of repeating itself, but it's always different. So if we think back to the last end of cycle crash, that was 2008 through to 2012. Property prices in Brisbane, Perth, Melbourne, and I do believe Adelaide went up in 2008, 9, 10, and 11 in Brisbane and Perth as well. So, you've got to take everything with a grain of salt because there is local factors. Last time it was driven by the mining boom. That sort of pushed Australian real estate a little bit higher in those years. And then obviously this time around, when you look at the mining sector coming back pretty strong at the moment, but then you've got the Olympic Games, which is going to cause a lot of speculation. It's going to bring a lot of jobs, a lot of population growth, a lot of infrastructure growth to Southeast Queensland, but Brisbane in particular. What Phil said to me in person when we caught up for dinner was he actually indicated that Brisbane should be the market that's least affected by the end of cycle recession because of these economic factors and the value of these big events that are coming to the market. But in terms of his predictions, he's just related to previous cycles. So over the last 3 cycles, the average Australian property has gone up between about 120 and 130%. And the average decline has been somewhere between 15 and 20%. He expects that to repeat again.
I really like the sound of this question. Thanks for sending it through. Does positive cash flow properties exist anymore with interest rates where they are?
Yeah, well, when I do my feasibility and when I do my cash flow analysis, it's really, really hard to find positive cash flow at the moment. Most people are coming in with somewhere between like a 5 and a 15% deposit at the moment. What I've noticed is like there is almost no opportunities in the markets that we invest in to get positive cash flow at the moment. I think that's most of Australia based on the affordability at the moment as well. Unless you're putting down like big deposits, like 20+% cash deposits on properties, it can be really, really tricky because once you factor in the interest repayments, and a lot of people are choosing to go principal and interest because it will reduce the interest rate that they receive at the moment, but that'll increase your expenses. Then you factor in the holding costs, insurance, property management, council rates, maintenance. It's hard to get positive cash flow at the moment. You can get neutral cash flow. And if you're willing to think outside the box and put down like 15 to 20% deposits and go for more dual income style properties, then, you can break into that neutral to positive cash flow scenario, but it is quite tricky at the moment. But what I would say to that is, you know, we do expect that to change because right now we've got high interest rates. The historic average has been around about 5% over the last 30 years. So 5%, you know, you probably see more neutral to positive cash flow properties around the country. But, you know, most people are at about a 6 to 7% interest rate at the moment. So it can be extremely tricky to get there. On top of that, the big four banks and the RBA all believe that the interest rates will start to come back down. Some predict that the cash rate will be at about 2.85% by the middle of 2025. So knowing that most banks throw an extra 2% on top of that, you're looking at around those 5% rates. So that would be really good if that does come to fruition. On top of that, CBA, CoreLogic, SQM all believe that rents will continue to rise with this population growth and with the undersupply of rental properties available at the moment. So, you know, it might be tricky to get positive cash flow for the next couple of years, but if you can get in at today's prices and you can get a little bit of a rental increase and you may get a little bit of a interest rate decrease, then you'll start to see a little bit of a balance. And, you know, for my personal properties, every single one of the properties that I've bought in the first couple of years have been negative cash flow, but have then worked their way into more neutral to positive cash flow. So sometimes it's just a cost to get into the property market in those earlier years while your debt position's higher, while your income is lower and your interest rates are higher as well. Once again, sorry for the long answers today. Like normally I like to 1 minute get these things in and out, but there's some more difficult questions with some nuance about them as well.
Awesome, love it. Now it's really good to get some extra information on some of these when we're talking about the 18-year cycle and we're just talking about the markets right now. Like it is a little bit more difficult and there's a lot that people are wanting to know. We're really excited to see some more questions from you guys. So continue to send them through and hopefully next month we'll be able to bring you some answers to some more of those.
Now, if you're seriously considering getting into the property market over the next 3 to 6 months, then we would love to offer you a free strategy session. During this strategy session, we'll talk about where you're at right now and where you're hoping to be in the future. We'll provide you with a really detailed update on the Australian property market and point you in the right direction as where you should be focusing. So you can go out there and crush it yourself, or if you need a little bit of support, you can become one of the few clients that we work with each month. If this is something that you're interested in, then please head over to our website, www.pumpedonproperty.com, and follow the free strategy session links to lock in a call with me.
Woo! That's a wrap.
That's a wrap.
Getting
Have a
cool,
spin.
bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that.
So nice, eh?